Good evening, friends. This episode goes out to all divorced men because alimony isn't cheap, and neither is rent or food or Costco stock. So today's goal is simple. Make sure you have alimony paid on time next month. And we do that by making money. So let's go make some money this week. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a lot of green in what is historically the worst week of the year. The last week in September tends to be violent, tends to be brutal, but we kicked Monday off on a positive note. However, it wasn't too green. We were just digesting a lot of last week's price action and looking forward to the upcoming economic data, earnings, and market moving events this week. We saw quite a lot of green in industrials, real estate, energy, cyclicals, defensives, utilities, basic materials. Everything this side of the heat map was very green. Everything this side of the heat map was quite mixed. We saw financial services, credit services outperform, PayPal up 1%, Visa and MasterCard somewhere in that vein as well. Nvidia up 0.3%, and semiconductors as well as software were actually fairly green for the most part. What really held technology back was Microsoft, Apple, Oracle, and Google. These names weighed on tech. Other than that, it was a fairly green day. You can see technology was actually down 0.2% for the day, the third worst performing sector, only behind financials and healthcare. The best performing sector was the consumer discretionary space. That was on the back of Tesla and Amazon rallying today. Materials up 0.4%, real estate up 0.4%, energy up 0.4%. Very interesting to see this dynamic. These are all like stocks that do very well in a heavy inflation environment, and we actually saw them rally today or gain against the broader market. Very interesting. We want to see what the inflation data is going to look like this week because we do get PCE data among other things. But all in all, when you look at the broad market, the factor and size spectrum, you can see that it was a green day. Large growth core value probably performed the best. Individually, mid-cap core was the standout sector, but all factors in all sizes roughly performed the same today. And I think we're probably going to see very similar trade up until we get the economic data on Thursday and Friday. This week we have a heavy week of data, and today we got the manufacturing data. US manufacturing shrank more severely in September than in August and actually hit a 15-month low. It's been one of the parts of the economy that is hurt the most by high interest rates. The overall figures here, the composite PMI, the manufacturing PMI, and the services PMI, show that the economy is still growing at a healthy rate, but there are some warning signs, most notably the dependence on services for growth. You can see global manufacturing actually missed. It reported 47. The consensus was 48.5, but services PMI actually grew 55.4 against the consensus 55.3. So anything above 50 is expansion, below is contraction, and we actually beat the consensus expectation here, leading to the overall composite of 54.4, beating the consensus. So we're still seeing growth in manufacturing, but it's heavily dependent on the services sector right here. Several reports are coming out this week, which is going to offer more context for where the US economy stands. On Thursday, we get the final GDP revisions for the second quarter, as well as consumer spending with the PCE data on Friday. We also had a number of Fed speakers today, most notably Bostic as well as Kashkari. And Bostic said a couple of notable things, and I quote, "Inflation and the labor market risks have emerged much more quickly than I imagined at the beginning of this summer. In this moment, I envision normalizing monetary policy sooner than I thought would be appropriate a few months ago. If the Fed wants to avoid a recession, we can't be behind the curve." That is what he said. Kashkari also came out and said the balance of risks have shifted away from high inflation and towards the risk of a further weakening of the labor market, warranting a lower Fed funds rate. So we can see that all of these Fed speakers are now on board cutting rates on the back of helping the economy, avoiding labor market weakness, as well as normalizing policy. Not a lot of talk there about recession, but they say we're doing these rate cuts to avoid a recession and bring everything back into balance. And on the back of all of that, the Fed speakers as well as the economic data, we saw the yield curve continue to steepen. The 2-year yield fell 0.28%. The 10-year yield actually rose 0.21%, as well as the 30-year yield. The dollar actually showed quite a lot of strength here today, and I think that's going to continue. I think we sort of found a floor in the interim here at the $100 mark. I do think the US dollar is going to weaken throughout 2025, but I think we're due for a bit of a bounce. We actually just pull up the chart. You can see right here, we're probably just going to bounce up and then continue the weakness into 2025. But this bounce could last anywhere from 3 to 6 months, to the upside and get as high as the 104, maybe 105 level. But looking at gold and silver, gold notching another new all-time high, up about 30% for the year. Absolutely crazy. The best performing asset class. If we actually go ahead and just compare this to the S&P 500, you can see gold up 27% year to date, the S&P 500 up 20%. Very interesting trade right here. Gold, the market telling us, rate cuts are coming, easier monetary policy, and gold is just a hedge against debasement. Silver actually fell here today. I think gold is the front runner for this rally. I think people just like to put their money in gold. It has a more consistent track record of moving higher on the back of easier policy. Looking at equities, it was a bullish day, except in the IWM. It fell 0.37%, but the S&P 500 and Nasdaq 100 were roughly up the same, about 0.3%. RSP gained here today. So too did the SPY. Mid caps up 0.5 percentage point. So the outperformer was actually the mid cap space. Very interesting trade, and do expect this to continue through the end of the year. Mid caps outperform in rate cuts, because in mid caps you get the best of both worlds from large caps as well as small caps. But looking at the S&P 500, we saw a very interesting dynamic. Number one, the advanced decline line ticked up as the S&P 500 went higher today. We also saw the gamma flip zone move from the 5550 area up to the 5600 area. That's bullish. And we saw the put support also move up. The core resistance remains where it is right now, but this price action right here is looking a little bit concerning. These are kind of like very mild doji candles. Oftentimes doji candles at a core resistance does signal a little bit of downside, but if the core resistance moves up tomorrow or for the rest of the week, I think we just pair those gains and move up. Candlestick patterns is not really something that I like to look at, but it is just an indication of what might come if the core resistance doesn't move down. But if we do pull back, guys, look to 5600 as the first leg of support for you to buy the dip and us to continue higher. Below the 5600 will be in negative gamma, and then we can actually move to the 5500 area. Something I would actually appreciate if we did get there, because I do want to load up and buy the dip. I was buying a lot right here. I was buying a lot right here, but in hindsight, you never bought enough, and that's just a human nature, I guess. But all in all, very constructive. The year-to-date chart in the S&P 500 looks very, very bullish, and you don't really want to fight the trend. You just want to buy at strategic locations. I do think we are going to move higher into the end of the year. I think we're probably going to finish the year anywhere above 5850, 5900. Some price targets on the street are seeing 6000, 6100. I think as the Fed cuts, we are going to rally. And generally speaking, when the Fed cuts and the S&P 500 is at all-time highs, 12 out of 12 times when that has happened, we have finished higher with an average return of about 18% in the S&P 500. Looking at the Nasdaq 100, very interesting developments. Nothing has really changed. We continue to trade at the core resistance and at this equal high level right here, and the gamma flip levels have simply not changed. So I think what the market really wants to see is sort of just like a breakout above this level right there. If we do go ahead and break that, that probably will mean if we do go ahead, break above this level and then pull back and use it as like a support zone, we can then target the higher levels. But until we actually go ahead and do that, it's any man's game if we go up or down from here. But you know what the plan is: above the gamma flip zone, buying dips, selling rips, leaning bullish up until the core resistance, and we're pretty much there, which means there is asymmetrical downside from here. Looking at the RTY, we did see a couple of bullish and both bearish developments. The gamma flip did move up to the 2175 area, but the core resistance moved from this area right here down to the 2275 area. Very, very interesting. So trading Traders think the IWM is going to go higher, but probably not until after the September week is over. That being said, this looks very constructive. You can see higher low, higher low, higher low, higher low. We broke these highs right here, and now we just got to like pull back, hold this low, and if we do find support right here, break above this high, break these highs, and that would be trend continuation on a 52-week high for the IWM. But it all depends on where we find support here and if we go ahead and break these highs. The IWM in a very weird place, because we do know that the second there's bad news, this index just literally dumps. And I mean, just look at these candles right here. The second we get bad economic data, everybody gets out of the IWM. They go to bonds, they go to large cap stocks. Whereas you look at the S&P 500, far more constructive. You look at the RSP, the most constructive chart, especially on a year-to-date basis. This looks really, really strong. You know, we had an impulse, an accumulation phase, and now we're moving higher, making higher highs, higher lows into new all-time highs. Very, very constructive. If you are going to buy dips in the RSP, look to the 175 area right here, and then we could actually go ahead, you know, break these highs. I think we see 200 in the RSP next year. And BMO Capital actually came out and said something very, very interesting. They said, you've got 339 stocks in the S&P 500 outperforming the market. We haven't seen that type of breadth and broader outperformance in almost 22 years. That speaks to the overall breadth and strength of this rally.
Brian Belsky of BMO. He joins us now because he raised his S&P targets, the highest on the street, 6,100.
And per our call, from a longer term perspective, we think that we're in this 1995, 1996 environment where we handled a 24 times earnings multiple during the times of the Nifty 50, which is very similar to what we've seen in terms of the Magnificent Seven. Lastly, I'll say this, and I think this is 2 points that people are missing. Number one, the Magnificent Seven and really the top 10 biggest stocks in the S&P 500 have underperformed in the third quarter for the first time in over 2 years. Yet the market's hitting new highs. I think that's very notable. Why is that? Because you've got 339 stocks in the S&P 500 outperforming the market. We haven't seen that type of breadth and broader outperformance in almost 22 years. And I think these are things that people are missing. We think that speaks to the overall breadth and strength of the rally that obviously we still see continuing.
I do think this is going to continue in the RSP in mid-caps into next year, and you do just want to buy dips. Those dip areas is 175, 171, and ultimately if we do get here, the 162 area, but I don't think that's going to happen. The RSP is acting really, really well in light of all of this. So guys, you know what you want to do. You want to buy dips in this market. Yes, valuations are stretched, but generally speaking, it's always good to buy all-time highs in the S&P 500, the Nasdaq 100. And when we do get these dips, if we do get these dips in this week, it is a very volatile week. Buy them, buy as much as you can. And for the S&P 500, that's at the 5600. For the Nasdaq 100, that's at the 9100. For the IWM, that's at the 2175 area. And for the RSP, that's at the 175, 171 area. And looking at sentiment, this is the II sentiment survey. Right now sitting at 15.8%. You need bulls for a bull market, and we have bullish sentiment through and through. Neutral is sitting at 22.8%, and bearish sentiment votes actually ticked down from 31 to 26.4%. We have very bullish sentiment, and this is a huge uptick from what we saw last week, where bullish sentiment was actually ticking down from the highs we made in late August. And that just goes to show the optimism we're seeing in rates right now. While optimism is very high in retail, it's also high on Wall Street. We've had a number of S&P 500 year-end forecast upgrades. The biggest on the street right now, BMO increased their S&P 500 price target to 6,100, Evercore at 6,000, Oppenheimer at 5,900, and this is material upside if we are to achieve it. You're looking at about 7 or 8% upside from the current levels. Look at Yardeni Research at 5,800 and Fundstrat here at 5,200, and this isn't a bearish price target. They just haven't updated theirs from the start of the year. Nonetheless, Wall Street is bullish, retail is bullish, but do the fundamentals justify these price targets? Looking at forward earnings estimates and valuation, and for the third quarter, earnings is expected to report at $4.6 4.6%, revenue of 4.7%, and this is where things get frothy. In the fourth quarter, 15% growth on 5.2% revenue growth. Very, very rosy. I think this figure is rosy and I think it needs to pull back. I also think the year-end 2025 figure is rosy. I think this 15.2% figure also needs to pull back. That being said, this is where estimates are right now. And for the fourth quarter, we're looking at 15% earnings growth. For the first quarter 2025, 14.6%, and the second quarter 2025, 13.7%. All on revenue figures above 5% respectively. Very rosy figures. Yes, everyone knows it. We do need to see these revised to the downside, but as it is right now, double-digit mid-teens earnings growth is what we're tracking. But earnings is one part of the equation. The other part is margins. And with earnings growing, Fed cuts on the way, disinflation in the rear view, slower labor cost growth is actually positive for corporate profit margins, and this should support modest profit margin expansion of about 80 basis points in 2025, and that should support overall price action and price discovery in the S&P 500. At the same time, we're also getting a cutting cycle when earnings is expected to grow. The Fed rarely does this. In most easing cycles, the Fed have always cut when earnings have decelerated or completely deflated when earnings were negative year over year. That is simply not the case today. And whether we get 12% earnings growth next year or 15% earnings growth, it doesn't matter because earnings are growing and we're cutting into a cycle where earnings is recovering and set to be extremely robust. But what exactly are management teams going to be doing with all of these profits? Well, right now they are buying back shares. This is both as private clients and their buybacks well above the 2019 highs. The most buybacks we've ever seen, pretty much ever. This was the high. We're above those 2019 highs. And this right here, guys, just reflects strong earnings and strong cash flow, reinforcing the overall optimism we're seeing in the market right now. And guys, let's talk about the macro. This is consensus forecasts for GDP, the consensus estimates, as well as Goldman Sachs estimates. Now, Goldman Sachs are very bullish. They see GDP growth for the third and fourth quarter of 3% and 2.2%. The consensus, not quite as optimistic. They see GDP in the third quarter of about 1.6, 1.7%. And I think the consensus may actually need to raise their price targets more than Goldman Sachs actually need to come down, because the economic data coming in right now is very, very strong. Look at last week's data. Building permits, housing starts, retail sales, very robust, very strong data in light of rate cuts. And the employment picture is also set to look really, really strong. Goldman Sachs expect roughly stable employment, and they see the unemployment rate falling from where it currently is at 4.2%. I think it's actually at 4.3% to 4% at the end of 2025. And looking at the next NFP report, Apollo Research suggests that the current jobless claims numbers of 219K suggests that the September NFP report could come in at 300,000 based on this data set right here, where R squared is 0.3841. I believe the current estimate for the NFP is close to 200,000, so this would suggest a very big beat. And if that is the case, that would literally light a fire under the market. We also got some commentary on Friday from Fed Bowman, and I'm going to go ahead and read this. He says, the US economy remains strong with solid underlying growth in economic activity and a labor market near full employment. Although hiring appears to have softened, layoffs remain low. I see the normalization in labor market conditions as necessary to help bring wage growth down to a pace consistent with 2% inflation, given trend productivity growth. My reading of labor market data has become more uncertain due to increased measurement challenges and the inherent difficulty in assessing the effects of recent immigration inflows. I am also taking signal from continued solid growth in spending data, especially consumer spending, reflecting a healthy labor market. So all in all, guys, the underlying fundamentals of the economy remain strong. Growth, the labor market, as well as the consumer. And until we actually see a deterioration in that, we aren't headed for a recession. And when the Fed cuts rates and there's no recession, stocks do well, the economy does well, the consumer does well, everything does really, really well. And that's why you want exposure to stocks. Now, what could bring volatility this week is earnings, guys. We have a number of key names reporting: Micron after the close on Wednesday, Accenture on Thursday, as well as Costco. And nothing major happened in today's trade, but tomorrow we do get AutoZone and then Progress. So still a light week here on Monday and Tuesday. Wednesday, Thursday is when things really kick off. A huge week of data, and tomorrow we just have the housing price index and consumer confidence, and then on Wednesday home sale changes, and then we actually get the big data prints: GDP, durable goods, PCE on Thursday and Friday, but we'll tackle those later on in the week and our expectations. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.